Welcome back friends to the class number 80, and in this video we will deeply understand about drop line overdraft limit, that is DOD, or some people say DLOD limits, right? So since you have understood about the overdraft facilities in full and cash credit facilities also, so this video will be a lot simpler for you to understand, because the DLOD facility, the drop line overdraft facility, combines the features of both overdraft facilities and features of term loan. Not all features, but some of the features of both of these products. So, what do I mean when I say that though both features of term loan and overdraft are combined in drop line overdraft facility? So, let us learn about them. Like overdraft facility, there is no stock statement required in DLOD account. Like overdraft facility, there is no drawing power calculations involved. Like overdraft facility, there is no stock audit involved in this facility. Like overdraft facility, the interest will be charged on the day end balance only. So if your limit is used on first at rupees 1 crores, for example, you have your limit utilization at the end of first October of rupees 1 crore, then interest will be charged on 1 crore. And on second, if your limit utilization is only 50 lakhs at the end of the day, then the interest will be charged on 50 lakh rupees for 1 day. And for that also, interest will be charged for 1 day, just like overdraft facility. Just like overdraft facility, a separate account shall be opened. Like when you take CC from the banks or overdraft facility, you get a separate account number from the bankers, and you do all your transactions in that account number. You can do RTGS from there, you can do NEFT from there, you can receive checks, RTGS, NEFT, you can pay your check payments from that CC account. Monthly interest is charged on that in that account, similar to that overdraft and CC. Similarly, DLOD accounts operates in the exact same way. So separate account is opened where you can deposit your payments, you can withdraw your payments by any mode that you like, even cash, right? So like overdraft facility, it is revolving limit only. Revolving limit means, so if for on 1st April, your limit utilization was 1 crore and sanctioned amount is rupees 1.2 crore. So on 2nd April, you make a payment of 20 lakh. Now your limit utilization went up to 1.2 crore. Earlier it was 1 crore. Now on 3rd April, you received a payment of rupees 15 lakhs. Now your limit utilization has dropped to 1.05 crore. Then on 4th April, you want to make another payment of rupees 5 lakh. Now your limit utilization shall go up to 1.110 crore. So your sanctioned amount was 1.2 crore and your limit got to the level of sanctioned amount on 2nd of April, but it doesn't mean that now you can no more withdraw money from your limit account. So if on 3rd April you have received 15 lakh rupees, then on 4th April you can withdraw 5 lakh rupees from your account. You can reuse that limit again up to the sanctioned amount level. So that is the purpose of revolving limit structure. So just like overdraft, it is a revolving limit only. So most of the features of overdraft facility are there in drop line overdraft facility as well. But what are the features of term loan that are involved in DLOD? That is where the difference comes between the overdraft and drop line overdraft facility. So like a term loan, the drop line overdraft limit has fixed tenure. This is the main difference. In overdraft limit, your limit is given for 12 months or payable on demand. It usually goes on perpetually, but not in the case of drop line overdraft. Drop line overdraft is given to you for a fixed tenure that can be 7 years, 10 years, going up to 15 years as well, right? So up to 15 years, you can get the drop line overdraft facility, which makes it basically a long-term loan type facility. So unlike overdraft and cash credit where you only pay the monthly interest, in drop line overdraft account you will have to pay the monthly interest as well as the monthly principal amount. Since the total tenure is fixed, you have to pay off a monthly amount of principal in this limit as well. So monthly principal repayment is involved, but that principal is not paid by way of ECS. Like in your term loans, when you take auto loan from the bank or building term loan or machinery term loan, the EMI of that loan automatically gets deducted from your bank account. But there is no EMI structure in the DLOD account. Then how DLOD works? So suppose your DLOD is sanctioned for 1.2 crores for 10 years. By 10 years, I mean 120 months, 120 months, right? So every month your limit will drop automatically in system by 1 lakh rupees. 1.2 crore divided by 120. So it makes 1 lakh rupees per month automatic drop in your limit account by the end of the month. So suppose on 30th April, your limit was 120 lakh rupees. So interest will be charged on 30th April as per your utilization during the April month. Now on 30th May, your limit will automatically reduce by 119 lakh rupees. 119 lakh rupees, 1 lakh drop will be automatically applied in your limit account, and your eligible amount of withdrawal, that 120 lakh represent maximum amount that you can withdraw from the account. Now that will be reduced by 1 lakh rupees at the end of the next month. So it will reduce to 119 lakh rupees. So you cannot now withdraw more than 119 lakh rupees from your limit account. Similarly, on 30th June, it will get dropped to 118 lakh rupees, and similarly going so on till the end of the tenure. Now what happens is where the entrepreneurs makes the mistake. So suppose on 30th April your limit you got reduced, your limit was 120 lakh. So during 1st May to 31st May, you can use the limit up to 120 lakh rupees, since your limit has been set to 120 lakh at the end of 30th April. So what will happen on 31st May, suppose you are using the limit in full, you are using 120 lakh rupees in full, your utilization is 120 lakh, and you will be charged interest also for May month, right? So suppose you have been charged interest of 2 lakh rupees for May month period. Now what will happen on 31st May, your limit utilization will go up to 120 lakh rupees. 120 is your actual utilization, 2 lakh is the interest charged on your limit account. Your limit utilization has went up to 122 lakh rupees. But what will happen in the system, in the software of the bank on 31st May, your limit will get reduced to 119 lakh rupees. 119 lakh rupees. But your actual utilization will be shown as 122 lakh rupees in the system, right? So basically the 3 lakh rupees has gone overdue here. 3 lakh rupees has gone overdue here, which will be reflected as days past dues, and it will impact your CIBIL poorly. So what wrong thing that has been done by the entrepreneur here? He hasn't planned the drop in a smarter way. He should have ensured that on 31st May, his limit utilization should be below 119 lakh rupees at least. It may get higher due to interest charging. Suppose the limit utilization is 118 lakhs instead of 120, and interest is charged. So 120 lakh is the limit now. So your limit, which should have been 119, is representing at 120 lakhs. So it has gone up by 1 lakh rupees due to interest amount only. So this is also not a good thing, but this has a lower impact than the first circumstance that I have explained to you. So as an entrepreneur, you have to plan it in a smarter way, and as a banker, we have to guide this calculation to the entrepreneurs before sanctioning the DLOD limit at the time of our visit to the customer. So what are the other features of drop line overdraft? One thing you need to remember, that drop line overdraft cannot be given as a sublimit. It is a basically reducing limit, reduces every month. So basically works like a term loan. So you cannot give it as a sublimit. Sublimits are usually given for perpetual kind of limits, not for term loans. This limit cannot be given for capex purpose. Ideally cannot be given for capex purpose, but some banks are doing it, but practically they are wrong if they are sanctioning drop line overdraft for capex purpose. Because for capex purpose, your end use is pretty much clear. You make the payment towards suppliers, and your collection is is basically recovery for that term loan given to the to you. So what happens in DLOD? DLOD is a kind of revolving limit. You pay off the amount, you receive the amount, you pay off the amount. So basically, it is very hard to monitor whether it is being practically used all along during its whole tenure for capex purpose or not, because you may have make payment to the suppliers, but the next day you may get some payments from your debtors also in the account, and then the very next day, following day, you can again make the payment for your suppliers, for your vendors, any raw material supplier also. So basically, there is no practical control over the capex and dues in DLOD, which is why it is not generally good to give for capex purpose. But for working capital purpose, you can give the DLOD limit easily. So another thing that you need to remember in DLOD, that higher property coverage is required than OD limit in it. Overdraft limit has some its own features. DLOD has its some own features. It is given for a long-term period, 15 years tenure. OD is given for 12 months and it is repayable on demand. And due to you are taking the risk of higher loan tenure in this facility, you charge premium in your property coverage. You ask for more property coverage from the client to sanction the DLOD facility. And another thing, you are not taking charge in on any current assets as well in DLOD structure. So the assessment of drop line overdraft is generally based on the DSCR if it is given by the working capital department. If DLOD is being given by the lab department, then the assessment is based on FOIR calculations. While some banks that I personally know, they make the assessment of DLOD. Since the DLOD is not given for capex, it is given for working capital only. They make dual assessment of DLOD. They based the DLOD on DSCR as well, and they base the DLOD on MPBF norms as well. Right, dual calculations. So the monthly drops in the limit that we have discussed here, it can be monthly, it can be quarterly as well, it can be half yearly, and it can be annual as well. There can be a provision that instead of monthly drop in the limit, there is only yearly drop. So if 1.2 crores is divided by 10 years, so 12 lakh rupees per month per year will be the drop. So you will be able to use 1.2 crore for full year, but on the next year, after the end of 12 months, your limit will be reduced to 1.08 crores, then 96 lakhs, then 84 lakhs, similarly so on, right? So the drops you can manually decide whether you want to mark it manually, monthly, quarterly, half yearly or yearly. Most of the cases it is marked monthly only. So these are the features and product of features of drop line overdraft facility. I hope you have liked it. In the next video, we will give a comparison sheet of CC, OD and DLOD. Stay tuned with this channel. Thank you very much.